Welcome to Multifamily Rockstars. If you are new to apartment investing or already experienced, you will enjoy this show. You will hear from the leading experts in multifamily real estate so that you can be a better owner, operator, and investor. Real people, real stories, life-changing. And now, your host, Ryan Christopher Nunes.
Well, welcome to today's show. Today's guest is James Eng. James has originated almost $1 billion in multifamily loans nationwide as a senior director for Old Capital. Prior to Old Capital, he underwrote $750 million in commercial real estate loans for GE Capital Real Estate. He graduated from University of Texas at Austin with a finance degree. James, welcome to the show.
Hey, thanks for having me, Ryan.
Awesome. Let's jump right in. James, walk us through your background. Tell the listeners a little bit about yourself.
Yeah. So I made a couple slides. I'll just throw those up real quick.
Awesome.
And we can just I tried to explain my background in sort of three things. So sort of born and raised in Houston, where you are, went to school at UT, and then I did risk for essentially 8 years as an underwriter at G Capital. And then the last 5 years have been focused more sort of on the sales side, loan originations of multifamily. And then I've also invested in close to probably 25, 26 properties on the multifamily side as a limited partner across DFW, Austin, and San Antonio. So that's sort of my background in a nutshell.
Awesome. So you've put out a lot of great content, seemingly something each day that's been relevant. Just walk us through kind of a summary of what you've seen and heard these last few weeks.
Yeah, I mean, just from the economic side, I think the big difference sort of between 2008 and 2020 is really in 2008, it started at the securitization level and sort of worked its way back through. So sort of CMBS securitizations, let's say, for example, those started going bad. Banks started breaking up. Borrowers got hit, tenants got hit, then the economy halted. This has been sort of the flip side of it, where the economy is halting and nobody has a job. I mean, I threw this chart from unemployment. I think there's like 30 million that have filed for unemployment in the last 5-6 weeks.
Sure.
And essentially, the tenants aren't going to have money, and so borrowers aren't going to be able to pay the banks. Banks are going to default on paying investors who invested in securitizations, and that's going to really freeze up the money. So the government has sort of come in on the front side of this and said, look, we're going to do a ton of unemployment, stimulus payments, all this type of stuff. And one of the charts here that Newmark put out, essentially, if you're making any 55,000 or less on unemployment, you're going to make more until July. So I think they're trying to sort of front run a lot of this. And the other piece of it I wanted to add was sort of the credit cycle and where we are. And I like this sort of summary of it. I mean, in prosperity, there's so many lenders that are lending in the market, cutting interest rate, lowering credit standards. But right now, I would say we're sort of on the backside, sort of that line through the middle. Losses are starting to come up. Forbearances are increasing. Defaults are going to start increasing. And essentially, lenders are going to pull back. And so right now, everything's super tight. They're putting in covenants on interest rate, or not interest rates, but interest reserves. There's less capital in the market. A lot of bridge lenders went away. And right now in multifamily, it's really Fannie and Freddie are the name of the game. So I think that's where we are in the credit cycle.
No, that's really helpful. And then what short-term and longer-term changes do you think come out of this through this credit cycle?
Yeah, I mean, short-term, just off the bat, I mean, Fannie and Freddie have sort of given sort of their forbearance. Essentially they're saying, all right, the same way with your loan agreement, they're saying, here's the forbearance agreement, take it. This is the only thing you can really do. We're not making any special cases for anybody, 90 days forbearance, but essentially you got to pay that money back within 12 months, which is going to be difficult. You're not going to be able to evict anyone during your forbearance. And then you're not going to do any loans with Fannie or Freddie while you're in forbearance, and they're going to sweep all the cash. So that in the short term is what's sort of on the loan side for existing loans, right? So if you're already in deals. In terms of new loans, I mean, the big thing is interest reserves. So anywhere from 12 to 18 months of interest reserves for Fannie Mae, Freddie Mac small balance, all of those. The big thing I would say also on the Fannie side is you used to be able to rate lock your deal pretty early, let's say 20 to 30 days into your loan application. Now they're having you wait to do your rate lock. So it just adds to the uncertainty on the Fannie side. So what I'm seeing a lot of buyers do is really focus on loan assumptions. The amount of money that's already put out. You already know the interest rate. So that at least takes one thing off the table in terms of uncertainty. But that's probably what I'm seeing the most of in terms of if someone's trying to buy a deal right now.
And what do you think the longer term impacts are to underwriting?
Longer term, I mean, I think it's going to slowly, the way I think they came out of the last recession was really they're going to stick to probably that 75% LTV 1 year IO for a lot longer, right? So I think the first thing that comes off is the interest reserve. So that might come off towards the end of the year once we see collections sort of stabilize, the economy come back, the interest reserves come off. And then right now there's a lot of layers of LTV and debt service coverage. So those come off. And then you slowly start going back to 75, 80% leverage. And then right now it's still sort of that 1 to 3 years interest only, but I think that slowly opens up. But I think it's going to be a while. And so I think there's going to be a while where most people are going to just underwrite 75% LTV, 1 year interest only.
Thank you. And then you've done a great job of kind of putting an analogy of lending options to ice cream. So just walk us through the different financing options for multifamily assets.
Yeah, I mean, a lot of people sort of start, I would say, on the left-hand side of this chart with just your typical bank loan. And this is going to be for your new investor. It's going to be a 5-year term, 20-year, 25-year AM. Let's say right now you're probably at 4.75 to 5%, and you're at 75% loan to value, but it's recourse, right? So of all the options, this is the recourse one. And what that essentially says is, look, if something goes wrong on this loan, I have to foreclose on it, and I sell the property for $5 million, your loan is $6 million. You're responsible for that $1 million difference in deficit. So most people start there. If you have experienced partners that can work with you, you can go into Fannie Mae and Freddie Mac, and those are going to be for stabilized deals. So 90% occupied for the last 90 days, and those are going to have better terms. So it's non-recourse. It's going to be a couple, 1 to 3 years interest only, and then it'll go to 30-year AM after that, and it can go all the way up to 80% leverage. And then the last one, which I would say as people get more experience, or if the deal doesn't really qualify for Fannie or Freddie, let's say occupancy is low or it's a big CapEx play, then you might go to a non-recourse bridge. And those are going to be up to 80%. It's going to be over 5 million, and they're going to want experience operators to jump in there. So those are what I would say is sort of your options for multifamily investors out there.
Awesome. That's you went through that really quickly. That's great. And then just walk us through the lender underwriting process as well. How do they size loans?
Yeah, I mean, I don't think I have a chart on that, but essentially, if you look at this, they're really looking at the number one, LTV, right? So when you start the process with the lender, they essentially engage 3 third-party reports. So you have your appraisal, engineering, environmental. Environmental is looking at making sure there's no sort of contamination on the property, gas stations or water contamination underneath the property. And then the engineering is going to look at the physical condition of the property, and then the appraisal is going to look at really underwriting the income of the property. And so in terms of environmental, usually on multifamily, we don't have that many issues. Engineering, they're going to look for immediate repairs. And then on the appraisal, they're going to underwrite the cash flow, and the lender is going to use that really to get to a 125 debt service coverage. And so what that means is, let's say your debt service, P&I, principal and interest is 100,000. Your NOI needs to be at least 125,000. And so if it's 110 or 115, then they're going to cut your loan to reduce the loan amount to hit that 125 debt service coverage. And so once all those reports come in, it usually takes about 2 to 3 weeks. Once those come in, they also get reports in from the borrower around net worth and liquidity. So let's go back. Let's just use an easy example. Let's say it's a $5 million deal, $4 million loan. The sponsorship group needs a net worth of $4 million, and then 400,000 or 10% of the post-close liquidity, 10% of the loan amount in post-close liquidity. So they get all the bank statements in. And so by the time you sort of do the third parties, you send in all your documents as a borrower, then they are submitting that to the lender's sort of credit team. And once they approve it, then essentially you move to closing, lock the rate, and then close the loan. So most of the time, that's about 45 to 60 days on Fannie and Freddie. Bank and bridge loans can close in about 30 to 45 days.
Oh, appreciate that. And then how do you think about matching the financing choice to the business plan for an asset?
Yes, I mean, if on the bottom of this chart, you can see sort of the prepayment penalties. And so on your bank loans, it's really going to probably be like a 3-2-1 step down. So 3% of the loan down to 1% of the loan. And then on bridge loans, it's typically 1%. So the challenge is most of those loan terms are 3 to 5 years, right? So as you get deeper into, let's say, a positive cycle, right, and you don't know when that downturn is going to hit, if you only have 2 years left on your maturity, then that's going to create a lot more stress, right? So people have to be flexible. I think what I'm seeing is that people who, let's say, in the last couple of years, they probably had investment timelines of longer than 5 years. So they were going out getting 7-year or 10-year Fannie Freddie debt. And because if there was a downturn, they didn't want a maturity right in the middle of it. If you're into a deal, let's say we're coming out of this recession, let's say at the end of this year or beginning of next year, and the deal is just broken, right? And you need to improve occupancy, you need to put some CapEx into the deal, and your plan is to really hold it just for 3 to 5 years. Most people are going to come in and do bank loans or bridge loans to fix those deals and then get them stabilized. So I think most people have sort of a 5-year horizon, but you want as much flexibility on that prepay to give you the option to get out of the loan, and when you go to sell it.
And then what do you think about, leverage, the pros and cons of, getting 80% LTV on an asset or 75% LTV?
Yeah, I mean, the higher leverage you go, obviously, the higher the return on equity is going to be, right? Because I mean, Fannie Mae rates right now are probably like 3.5%. Freddie, you're at 4 to 4.5% on Freddie SBL, and so the rates are lower than any equity investor is ever going to give you. And so the higher leverage you go up, the higher your return on equity is going to be, but also the higher the risk goes, right? So right now, everybody's looking at collections right now and focused on, can I make the debt payment, right? So the higher you go up on the leverage curve, the more risk you're going to entail. So I like probably that 75 number. What happens though is like lower class deals, like Class C deals, are going to qualify for 80%, right? Because you should be buying those deals at higher cap rates, right? Mm-hmm. So an A deal has the same debt service constraint as a B deal and as a C deal. So what we typically see is A deals are typically 60% levered, B deals maybe 70%, and then C deals can go all the way up to 80%. Most people are taking the max leverage that they can get from the lender right now. And one way to mitigate sort of that risk is maybe raise up to 75%, or let's say your loan 75%, raise the other 25%, and then you end up getting 80%. You can have that choice on whether or not you want to take it at that time.
Okay, no, that's great. And I guess do a special distribution if you decide not to take or if you take the 80%.
Well, it's up to you, right? So one of the questions we had on a call yesterday was like, how much reserve should you have in the bank for your property, right? So is it 1 month of expenses, 1 month of mortgage payment? Is that enough, right? Or should you have 6 months? Or should, one syndicator was like, look, for every 100 units I have, I want to have 100,000 in the bank or 150,000 in the bank just for things like this that come up, right? So
do you think that's enough, James, or what would you kind of guide people to?
I think it's different for every general partnership. And so there's some general partnerships where there's 10 general partners on the deal. And I think it depends on, if I'm a general partner, I'm going to look deal by deal. And Fannie Mae doesn't really do this, but Fannie Mae looks at your liquidity. Let's say you have 500,000 liquidity and you sign on 5 deals, right? Well, you can go get a $5 million loan on every one of those deals. But then if all 5 deals go bad, that 500,000 is not replicatable across all of them, right? So me as a general partner, if I was going to be a general partner, if I'm looking deal by deal, I want to be able to support every deal that I do.
Interesting.
Especially if you do not have other strong partners in that deal. Like if you're the main sponsor on a deal, then you should be able to front the money on these deals. Especially like right now, there's a lot of investors coming to me and saying, look, should I take forbearance or should I do a capital call? And I'm like, well, you should be able to front the money for your deal.
Sure.
And some of the general partners I talked to yesterday, I mean, they have almost never gone back for a capital call to the limited partners, right? So that's sort of, when you sign up to be a general partner, that's one of the things that you need is liquidity to support your deal. So most of the deals that I'm invested in, I work with these general partners a lot, so I'm on the phone with them. Most of them, they're usually about 200 to 300 units right now, and most of them have anywhere from $500,000 to $1 million in reserves right now.
Okay. And so you've invested in a number of different markets and across different, classes of multifamily assets. So are you concerned about kind of where things sit now as a passive investor?
I mean, we did so I get sort of updates on collections all throughout April. I mean, essentially everyone collected close to probably on average 95%. So I would say A deals were probably 97, 98, B's at 95, and C's are probably 90 to 95% across all my passive deals. And so right now I'm not too concerned. We'll see how May comes out, but I think right now all of those deals have sufficient liquidity, which I think is the bigger issue. Because I mean, usually expenses are about 50% of your revenue. And then, your mortgage payment might be 25% of your revenue. So I don't think until you start collecting, like, let's say 75% only of your rent, that's when you start drawing down on your reserves. And we haven't hit that point. And then even if we had to draw on reserves, all the deals have the liquidity to sustain the deal for a pretty long period of time, anywhere from 6 to 12 months, where they could pay expenses, pay the mortgage. And only one deal out of 20 deals right now has a maturity in the next, I would say, 12 months. I think it's summer of 2021. All the other deals have anywhere from 4 to 10 years left on the maturity.
So how are they thinking about refinancing that one that's coming due next year?
That one, they're already working on the refi. Okay. So they've already that deal they bought in 2018, and so they've done all the rehab, they've turned the units, and now they were debating whether to sell this year, but they're not going to sell this year. They're not going to take that big of a haircut to sell into this market. So they'll refi at a lower rate. So instead of maybe getting, let's say 75 to 100% back in capital, we'll probably just get like 50% back or 25% back of our initial capital. And then they'll reset the loan maturity. And then we'll probably do something with a flexible prepay, right? So something if, let's say the market turns in 21, 22, someone comes to us with an offer, then we can sell the deal. So unfortunately, we're just holding that deal. Instead of holding it 3 years, we're going to probably end up holding it 5 or 6 years.
Got it. And then we've seen a few distressed deals already.
Sure.
Just walk us through how and why deals go bad.
Yeah, I mean, here's a couple reasons that I saw. Number one, if you're already struggling before COVID, so I've seen some properties where they changed the management company, let's say in December, and now because they were already having issues, now they moved into January, February, they were just getting ramped up, and then boom, COVID hits them. So they were 80% occupied, now they're 60% of collected on their overall, and those guys are struggling because there's almost no new leasing right now coming in the door. Let's say you had a bridge loan and you have a near-term maturity. I think those are, I've not seen a lot of those yet, but I think those are coming. Deals converting from IO to amortization. So Fannie and Freddie gave a lot of deals that were sort of like 3 to 6 years IO or full-term IO. Once they start converting to amortization, they might be in trouble. And then actual expenses. So taxes are, we're going to see a huge increase in taxes. Insurance is also increasing significantly, payroll, R&M, and then also employer concentration. So if you have a deal that, whether it's, next to a car plant or next to an oil oil company that
Sure.
just laid off half their staff. I mean, and your property is sort of in, I don't know, the energy corridor of Houston, and that's going to take a longer time to lease up. And then just undercapitalized ownership groups. So, I mean, it's almost better. I mean, timing wise wasn't great, but let's say you bought a deal in the last 3 months or something like that. Like, let's say in 2020, you're like, man, this is the worst time. But hopefully you raised all your capital and you're sufficiently capitalized. The challenge might be for somebody who bought a deal, let's say 2 years ago or 3 years ago, they used all their money. And
Sure.
now, they had 1 month of expenses, 1 month of mortgage payment in the bank, and they hit a rough skid here for the next 3 to 6 months, they're going to be in trouble.
Sure. And then you've worked with a lot of owners and operators. Any trends in terms of the outperformers and why they do well from an acquisition and asset management standpoint?
Yeah, I mean, I'll jump over this, but from the partnership side, I mean, I would say number one, they have either a very strong management company that they control and manage, so they self-manage, or they have a very strong relationship with their third-party management company. And those people, they sort of have a system in place. They're, as soon as they take over the property, that property management company is already underwritten the deal. They already manage deals in that market, and they just go in and just start working on the deal. Where I've seen people run into trouble is they don't have that strong relationship with their management company, and operations suffer, capex suffers. Things take like as a lender, a lot of things we track are, let's say, immediate repairs and capex, right? So immediate repairs are supposed to be done in 6 months. Capex is supposed to be done within 12 months. Like if that stuff hasn't been done, if it's like not interior rehabs, but it's other things, like things you have control over, it's outside the units, like all that stuff should be done, right? And that is more just the asset manager being on top of the management company, making sure they get deals done. And then, I mean, it also comes back to liquidity for a lot of these general partners. I want them having not only money in the deal, but then also money to support the deal.
Okay. And so these are kind of your personal investment philosophies, what deals you choose to invest in and why.
Yeah. So I thought, there's not a lot of deals on the market right now. Right. So I was like, maybe I should sit down and write this out. So I was on another podcast and they were like, all right, what's your investment philosophy? And I was
Sure.
like, well, I sort of just rambled off a couple things, but I thought this would be good. And I'm sort of trying to formulate this a little bit better. So you're getting an early look at this.
No, that's
Um,
awesome.
so I broke it out into a couple different categories. And what I would like is for people to challenge this and tell me I'm wrong on these things, because that's the reason I'm doing it. Is I think if you have a good investment philosophy, like I would say in the first quarter, I would probably get 10 deals a week, right, to invest in.
Wow.
And I would almost, if you don't have an investment philosophy, you start digging into like every deal,
Absolutely.
and like, and you're just taking a lot of places. So let's just start with this. All right. So I started with cycle timing, and so I heard this. So Neil Baldwin talked about he's going to stop distributions when he sees 2 consecutive quarters of negative GDP growth. And I thought, all right, let's look the opposite way. Like, when should you be investing? And I said, all right, when I see 2 consecutive quarters of positive GDP growth, I think we're ending that bear market, entering the bull market. And so it's going to be a little bit tricky. That might extend to 3 consecutive quarters of GDP growth. But like, I looked back at the GDP chart, and I don't have it on this slide, but essentially, 08, 09, there was 2 negative consecutive quarters of GDP growth. Q1 of this year will be negative, whatever, 4.5%. And then Q2 is going to be, I don't know, negative 20, something ridiculous. But Q3, if it spikes back up, but then goes back down in Q4, then it breaks that test, right? So
Sure. Sure.
2 consecutive quarters of positive GDP growth. It's almost like we're going to go up and down here for a little bit. But then once, let's say in 2021, second half, we see, +3, +2. And then I think there's going to be a runway there. And then, Fannie Mae, before they release your debt service coverage, they want 2 consecutive quarters of 125 debt service. So you can't fool them. So I thought they were pretty smart. So let's just go with that. That was number one.
But just a question
Yeah.
on that,
Yeah,
though.
yeah, go for it.
If you see that happen, 2 consecutive quarters of positive GDP growth,
Right.
wouldn't that imply that you think, okay, the S&P or stock markets are going to be high, all asset classes are going to be higher because the market has kind of turned the corner. So
Right.
then
Sure.
how do you find, wouldn't you be like inherently overpaying then for assets that you're buying versus what you could
So
have?
I will, if you go back to the first 2 quarters of positive GDP growth coming out of 2009, it was 2010, 2011, 2012. It almost took the real estate market almost not until probably 2012, and I can maybe pull the chart, but
Sure.
it was essentially like flat. Real estate lags, right? And so not until really 2012 did prices really start going up.
Okay.
And so right now, the main thing that this is preventing is trying to catch that proverbial knife that's falling, because there's deals now, right? There's deals
Yes.
now that you could buy, but this is just one way of protecting it. So yeah, I'm gonna miss out on some deals, right, where you
Sure.
think it could be the deepest deal, deepest discount to the deal, but I'm okay with that. So the second is that any other questions on the
Yeah,
GDP
I
growth,
guess,
or is that
just
guess?
from a philosophical standpoint, just taking a step back, I mean, just looking through this, I'd love for you to go line by line, but does it seem that you look for the more, safer part of the risk spectrum in terms of multifamily
Yes,
assets? Okay.
yes, I would say that's true. So especially me as a passive, I don't need. Um, I love this quote: "Is investing is a lot like baseball, right?" And so if you're a hitter, you can take strike after strike after strike after strike, and you never strike out. Um, and you only need to take a couple swings a year, right? Whereas a baseball player, they actually have to swing. In investing, you actually don't have to swing.
Yeah.
So you can look at a lot of deals, and you can be selective.
Sure.
And I don't know if I have the quote in this deck, but
That's a great one. Yeah.
yeah, Howard Marks basically said, people are known not because of really their home runs, but it's because of bad deals and how bad they went.
Mm.
And so
So
I'm okay with that. So I'm more cautious than most people.
that's
Probably
helpful.
my risk background coming in. So, you want me to keep going on
Yeah,
cycles?
absolutely. I think it's
Okay.
really helpful.
So this next one, the yield curve inversion. I mean, it's almost predicted, I think, the last 5 or 6 recessions. And, there was one, I can't remember if it was Q3 or Q4 of 2019. And that almost, I mean, whether it's coronavirus or something else that was going to take us into it. So I almost want to wait 18 months after yield curve inversion. Because if I had that rule in place, I would not have invested in anything in Q1 of this year.
Mm.
Right.
Sure.
So, and how I think about this as is sort of like a check mark. Like, I'm going to go down this list when someone sends me a deal, and if it hits all these things, then I'm in the deal.
Interesting.
If it hits 9 out of 10, then I'm probably still in the deal. But if I can't check any of these, then I'm definitely out. So let's jump in. So that was on the cycle timing. That's all I got right now.
That's
On
kind of the
cycle
macro
timing.
perspective.
Macro perspective before I start jumping in. Number 2 is property type. So I like stabilized deals, primary markets, consistent collections, over T12 and T3, and historically. And the reason, and I'll just sort of take these one by one, is I've seen deals that essentially people have bought. So let's say there's a run up from, let's say net rental is 50,000, 60,000, 80,000, 90,000, and then there's 3 consecutive months of 100,000. Okay.
Mm.
And people have paid on the T3 alone.
Sure.
And
They're buying the pro forma or cost of
well,
it.
it's there.
Yeah.
The property's there. It's just not, I wouldn't call that stabilized, right?
Sure.
It's only had 3 months, right? So I like to look back not only at T3, T12, and then maybe the last 2 years of financials. Second one on property, I like Class B now, as a limited partner, 150 units and up, no student, no senior, no employer concentrations, no new construction, no lease up, no development. That I've just seen. I mean, it's even more evident. I saw it at G Capital. I saw it. You see it right now. In terms of guys who are hurting, it's more the A side and the C side.
Sure.
The B's are right in the middle.
Interesting.
The third thing here is, even though I'm from Houston, I love Houston, I don't really want to do any deals on the coast or in a floodplain.
And just walk us through why.
It's simple. I mean, hurricanes come to Houston, floods hit Houston, hit Florida, hit just, and if a deal's in a floodplain, like there's areas in Dallas, the same in Houston, there's areas in Dallas and Houston that always flood, like regardless. And it could be just a thunderstorm or anything. But what I've seen is, let's say like there was a deal in Houston that someone sent me, and essentially the whole first floor got flooded. It was like a 400 unit deal. Whole first floor got flooded. They got insurance money and it wasn't enough money. And essentially you're just down, like just that big of a shock to your income. And by the time you lease it up, by the time you bring it back, and then even if you do have insurance, and the worst thing is if you have a deal and it's not in a floodplain, so you don't get insurance, and then you get flooded. And now all of a sudden, that 100,000 that we talked about per 100 units is not nearly enough money.
Sure.
And so if you are going to have a deal that's on a coast or floodplain, I mean, your reserves need to be significantly higher. And your returns need to be significantly higher to compensate you for that risk. And as soon as you can get out of that deal, I'd be out of that deal. So this is, a lot of people talk about this, and I tried to give an example to this, and this is harder for me, is the price of the asset is below its intrinsic value. And so a lot of people look at replacement costs versus the price they're paying, right? So it's easier on, let's say, a Class A deal in Houston. The developer cost them 150 a unit to build, and you're buying it for 125 units to buy. Like that makes sense, replacement cost versus. But on Class B stuff, that's a little bit harder.
Yes. So how do you think about that?
So I just look at that versus peak to sort of where I'm buying today, right? So if let's say in the last year, B deals in Dallas were 125 to 150 a door, and I can come in, let's say in the next year or two, for whatever reason, this deal is trading at 100 a door. That to me is, my 25% discount that I'm looking for, but it might not ever go back down to that level. So, as the curve has come up, it might dip a little bit, but I don't know if it's going to go back to the previous peak. Like the previous peak was probably 70 a door or 80 a door for Class B stuff. So is it going to drop from 125 down to 75? Probably not. Sure. Right. So, and then the last thing on property types, I'm looking for cash flow by year 2 of about 8%, and then 15 plus IRR on a 5-year DCF. So that just is like a gut check. One last gut check. If it sort of checks all these boxes, but I'm not making any money or cash flow, then there's probably something else I'm missing. But that's usually people start with that, right? They say, all right, this is my return hurdles, but they ignore everything else. All they talk about is, all they look at is, hey, here's my cash flow. It's 10%. Okay, great. But it's a bad neighborhood. There's a huge concentration in energy or industry, and it's in a floodplain. But it's 10% cash on cash.
Sure. So that it says on an amortizing basis. So that means after IO is burnt off, and they're
so P&I, So that makes it tough. Most deals, in the last 2 to 3 years have been, IO for 5 years or 3 years, and once it turned amortizing, it dropped from 10% to 5%, right? So that is a big step. So if that box is not checked, then I'm gonna have to evaluate whether or not it's the right time. And the way I'm thinking about this investment philosophy is like, this is like a snapshot in time. And if it needs to be adjusted, I'll adjust it. But this is sort of right now.
And just kind of, looking at your cycle timing, your macro philosophy, it sounds like you're not going to invest in any deals this year, just given that 18 months.
Well, that yield curve inversion, I was trying to think, should that be 12 months or 18 months? And what I was looking for is sometimes there was a lag between the yield curve inversion and when the actual recession hit. So it was preventing me from seeing or from investing too early, right? So a lot of times, let's say yield curve inversion hit in 2006, and then it's already been 12 months, and I invest in 2007 or the end of 2007, then it would have prevented that. So that 18 months would prevent that happening, right? But now that yield curve inversion has happened, and after that, there's just been this like lingering, when's the downturn coming? But now that we've seen the downturn, right? That, coronavirus is taking the GDP down. I think that point is negated a little bit for this particular recession. But then I think for future ones, there might be a longer lag, if that makes sense, right? If coronavirus hit like at the end of this year versus at the beginning of this year.
Okay. And then you talked about the general partnership below, or the sponsors. So maybe walk us through that.
Yeah. I mean, I want them to have at least 5 deals, make it through this downturn. I always like to talk to the previous investors of that general partner. We talked about sort of in place, how they're going to manage the deal. I want to learn about their management company, who they're going to use. I want them investing cash in the deal. And I actually want them to live in the market that they're going to invest in. Mm-hmm. I know that's a sticking point for people. But even though I was born and raised in Houston, it is still hard for me to know Houston like I do in Dallas. I mean, in Dallas, sure. I've lived for the last 14 years. And so I just know it better. And maybe it's a little bit, if my market was horrible, then I would, it'd be different. But for the general partner, I like for them to, whether it's once a week or every other week, I want them to be close to that property. Because there's some guys who live in California, they're investing in Texas, and they couldn't get on a plane last month to come to Texas, right? Mm-hmm. So, there's Zoom and there's all these other things, but there's nothing like just driving by the property or walking your vacant units to make sure that, somebody's not stealing from you, or that, these units are getting turned. There's just something about walking property and being able to drop by.
Yeah, that's great. And then you had talked about, maybe just walk us through the asset management, and then you just,
the asset management is just, right now you're seeing who the best operators are, and the people who communicate, the people who are on site, the people who are, very aggressive on collections, very aggressive on renewals. Those are the people who are going to make it through. So I just think, like I've asked general partners to send me a couple of deals and what's your monthly reporting look like, right? And just from that, you can tell, right? There's some general partners that they send me a 2-pager, and, and it's quarterly. And all it says is, this is the top line revenue, this is top line expenses, and, this is your distribution or no distribution. And, essentially like 3 paragraphs on the property, and it's been 3 months.
Sure.
And that's not enough for me. I want someone to essentially send me what they're getting from their management company, P&L, rent roll, general ledger, all that type of stuff. Because half of what I like about investing in multifamily is that you become a better investor every deal you do, for better or for worse. Sure. And if you only give me a 2-pager, I'm not becoming a better investor in that market.
No, that's fair.
In that deal. Yeah.
Well, I appreciate you sharing that. That's fantastic. Walk us through the different apartment classes and how they've performed historically. And then from that, what's happened to cap rates and where you think they're going to go. Sure.
So this is a snapshot that Marcus had on one of their slides. And, you can look, you can see that A and B have sort of stayed in that probably 5 to maybe 8-9% range on vacancies throughout cycles, right? What they're not showing obviously is, the concessions and rents that people are giving to get there. But the C class is really the difference in this cycle. Historically, it's almost always been, my guess is this is physical vacancy. And, C class spiked up to 12% on the C's, and it's probably worse in worse areas. Right. So, but it's driven all the way down to 5% in this last cycle. And, so that's what I'm advising people to probably, if you have a C class deal, you probably need to use 10, 11% physical on your modeling. If you're going to go buy a deal right now. And that's probably what you're going to stabilize in year 3, year 4 at. And your economics probably 15, right? So your economic total, economic vacancy is probably 15% if your physical's 10, right? Because you're not going to collect all the rent in this downturn. So I think that's probably the biggest difference. A and B were pretty consistent, but C was the biggest outlier, I would say. And this trend was this was a nationwide trend. I don't think this was just Dallas, but this was a trend I had on the vacancy side. And then same thing on the cap rate side. But
back on the vacancy. Yeah. What happened? There seemed to be, the A's and B's, relatively the trend has been, flattish or in a range, but the C's definitely went from a 12, 13% to 4.5%. So what fundamentally changed?
So, the people who, the last crisis, I think the big difference between that one and this one was that in 07, 08, you essentially, the whole subprime mortgage was an issue. So if you lived in a B or C class apartment, you could go buy a house essentially. Right now, you don't have that option. And a lot of people who came, I would say a lot of people who went through that process and either got foreclosed or I think a lot of people the last couple of years have really seen more of the shift. I don't have a home ownership chart, but the home ownership chart probably should show this as well, is that a lot of people just aren't buying houses anymore.
Sure. Probably is the opposite of what's happened in the C class, I guess.
Yeah. And so, I don't know if a lot of tenants in C class were jumping to buy houses, but in the last one, they were to some extent. And so I think not until they got foreclosed and kicked out of their house did it really start coming down in the last recession. But yeah, to me, it's almost like a demographic shift to some extent. Is there's just a lot more people who are wanting to live in apartments, and that's why people are unsure on this one where the spike's going to be. I would just forecast it at 10% physical, 11% physical, and then this is another reason why I sort of like the B space, is that you're not going to have as much volatility.
Yeah, sure. That's great. And you had a chart that you had pulled up on cap rates there.
Yeah. So this one, I tried to find one that went as far back as possible. I think CoStar is probably okay at cap rates, not the greatest, but this one showed, essentially there was like a 400 basis point gap between A's, which was the blue line, and orange, which was the sort of C deals. So 400 basis points, and then that probably compressed all the way down to 100 basis points. So this was 2017, and it kept going down, and it kept compressing. So I would say it was probably, in 2019, it was probably 5, 5.5, and then 6 on C's. And I think it's gonna sort of go back out. Probably, I would say probably to 200 basis points. I don't think it's gonna go back up to 400 basis points though. But I do think it's going to go back to maybe like 8, 7, 6 potentially, or, 5, 6, 7. I think it's going to be at least 200 basis points between A, B, and C, especially as C's get hit a little bit harder. But, one of the guys that I was talking with yesterday, he essentially, a lot of these deals that are broken, there's no cap rate. There's,
Sure.
It's negative cash flow right now. Your expense ratio is 80%. There's no cap rate. So for the next 2 years, you might have no cap rates on these deals.
Yes. So, a few questions for you. What do you think has, caused the C's to come down that much in terms of cap rates? Also, do you think the roles of syndicators and the advent of all these, syndication programs has created kind of an artificial supply demand imbalance?
Well, yes. So I did an update on sort of the DFW market, and I looked at, there was like 85 deals that traded in Q1. And if you look at the A's and probably B plus deals, all of them were REITs. There's probably out of 40 deals that traded, there was maybe 2 or 3 syndicators. But if you go look at the B and C space, almost every single one was a syndicator.
Sure.
And so that is the space that they're in, for sure. And yes, I think what was interesting was guys who had been in the industry, let's say they bought in 11, 12, 13, when they sold in 15, 16, 17, 18, everybody that they sold to, they had never heard of any of those buyers. It was all new buyers. And so now it'll be interesting to see, like, as we go through this cycle, which syndicators stay and which ones are able, or which ones are just going to fall by the wayside. And and this is a question I asked some experienced operators yesterday, was around how do you go from like the 1 to 4 units? Let's say you have 1 to 4 properties as a syndicator. Like, you can make money like that, but the guys who really make money as a general partner, they have 10, 15, 20 properties at all times, right? And they're just cycling through those deals. And their answer was, you got to do the right thing. And that meant if your deal's in trouble, you rescue the deal, you save the deal with your own capital. And all these guys were owner operators. They were like, look, I didn't take management fees. I didn't take any fees on the deal. I wanted to make sure my investors got their money back. And if there was a return on that investment, I got that money back, or got that return for them. But their number one thing was that preservation of capital.
Got it. And then, you had touched upon where you think cap rates are going to go. Where do you think there'll be buying opportunities?
Right now it's pretty early still. I mean, I think some of the C deals, some of the lease up deals on the Class A side. But I think in the next year, people are still going to bring their deals out to sell. But it's probably not going to be at the discount you want to buy at. And so that's where there's going to be this whole price discovery on let's say a B deal that they were going to bring it out. So we saw some deals. Let's say they brought it out in January or February of 2020, and they wanted $31 million. Some of those deals went under contract at like 28. So people were willing to take like a 10% haircut or so on the deal. But they had bought it for 20, right? So they still had an $8 million gain in the deal. So they were like, yeah, I know we thought we were going to have 10, but it's only 8 now. And people were okay with that. But yeah, I mean, I think towards the end of this year, hopefully some of those deals will start coming out maybe January, February, once we have at least probably one positive quarter of GDP and people start seeing there's a little bit of light coming out of this thing. I think deals are going to be back on. But if people are like me and they're like, look, I want 15% IRR or 20% IRR, then it's going to be, the pricing is going to have to change.
Sure. And then you had talked about deals that have no cap rate. How do you think about underwriting those? Because we've seen a few of those, and kind of what's your thoughts about how to deal with those?
It's really different. So most deals in the last 2 to 3 years have been, all right, I'm buying it, it's 90% occupied. I'm going in, putting $5,000 a door. I'm gonna raise rents $100, $150, and then I'm gonna sell it year 5. And the whole time it cash flows. Whole time you're essentially going cash on cash is 5%, and I'm going to take it to 10%. Everybody loved it, and it worked. Now, if a deal's broken, let's say expense ratio is 85%, you got to figure out, is it an expense problem? Is it a revenue problem? Is it an occupancy problem? You're going to fix that, and that's going to take anywhere from 12, 18, 24 months. So your cash flow is going to be 0, or you're going to have to carry the interest, and then all your gain is going to be on the residual. So, and it might take you longer than 5 years, right? So if rents are flat for the next 3 years, it's going to take you that much longer to get out of it. So I think from an underwriting perspective, the big difference is, besides the down payment, is you probably need at least 12 months of interest reserve. And I would have more working capital just in case, because if you're not only going to have to do the rehab out of your own money, but then if your rehab, you thought it was $200,000, it ends up costing $300,000 because you couldn't do the adequate due diligence that you thought you could do. You couldn't walk all the units. You're going to just have to end up buying these deals, sort of sight unseen. The only positive sort of on the buyer side is that sellers are going to be a lot more flexible in that, before you had earnest money, you had, tight due diligence timelines. Now it's going to be, you can take as long as you want. I don't care. There's no more other buyers.
Sure.
So if you want 90 days to close, fine. If you want
Sure.
financing contingency, fine. Like, I don't have anybody else behind you. So
Sure.
that is your number one benefit as a buyer. You just have to be able to wait it out, because it's going to take a little bit longer for
No, I
these deals to
appreciate
turn.
that.
Yeah.
That's great. Now, James, this has been really helpful. Just a few more questions before we
Sure.
wrap up, but I've always been interested in this one. So,
Yeah.
Old Capital, how do you compete?
Sure.
There's a lot of investment sales platforms, particularly in DFW, that also have kind of lending arms. So how do you capture so much market share?
Yeah, I mean, the best way so in a market like we've been in the last 5 years, when sellers have dictated terms and listing brokers have dictated terms, March 15th or whatever day Trump shut this thing down, that all changed. And now the shoe is back onto the buyer side. And now buyers actually have a right to put in their terms, like we were talking about, in terms of earnest money, in terms of who they're going to use for lenders, all that type of stuff. That has dramatically changed. So that's number one. But from that example, I want to use examples from the buyer side and the seller side, because I think it's a conflict of interest to some extent when the listing broker is in an office here, and then down the hall the lender is in the office with them. And from let's take it from the buyer side. Like, to me, the lender should be on the buyer's team. And so if the lender goes out, we talked about inspections that they do, right? The lender goes out and they find issues with the property, they're going to be up front with the buyer and say, look, this unit's down, this is an issue, this was supposed to be a certain type of panel, it's not this panel, the wiring is supposed to be this, like all those things.
Sure.
That's what the lender's supposed to help you with underwriting the deal.
Mm-hmm.
Right? And if the listing broker and the lender are on the same team, and the lender says, I was going to tell the buyer this, but that's going to reduce your sales price, the listing broker is going to tell them, hey, don't tell them that. Just, glaze over that and don't worry about that. So all of a sudden, there's all these small things that add up for you, the buyer, right? That aren't good for you, right? And so I've seen that on the buyer side. On the sales side, so let's say you're the seller, and you take a deal out, you hire the listing broker, and you're like, hey, I want $20 million for this deal. All right. And then listing broker takes it out. He has a buyer, $20 million, but they're using Old Capital for the loan. And then they got another guy for, I don't know, 19.8 million, but they'll use that listing broker's lender. And the listing broker says, hey, I want you to use this guy at 19.8. And they choose that guy. Mm-hmm. Right? All of a sudden the seller's out that $200,000, sure, even though the execution would probably have been the same,
sure,
if not better. And this is as close to reality as we can be. But another issue that comes up, and we've seen this, is let's say they choose the guy at 19.8 million, right? And the listing broker's lender is doing the debt. And all of a sudden COVID-19 hits, or something comes up in underwriting, and the lender says, I'm not doing the deal. And the buyer comes back and says, well, give me my earnest money back.
Sure.
I put $500,000 earnest money, or whatever the earnest money was, and I want my money back. And the seller's like, what are you talking about? It's my money. You default it. And then they're going to look to the listing broker and say, well, what are you talking about? You told me to use this lender. If I had used my lender, I would have closed the deal. So all of a sudden, like all these, like when everything is up and everything closes and everything goes smooth and there's no issues, you don't feel all those different tensions.
Sure.
But as soon as like there's one hiccup or two hiccups, like all of a sudden sellers are going to say, look, I don't make any more money if the guy who finances the deal is Old Capital or the listing broker shop. I care about getting $20 million for my property. That's why I'm hiring you. Right.
Sure.
And so as sellers and buyers go through that process, I think it's gonna shift, especially as buyers have more, more power.
So it sounds like it'll shift to best execution, period.
Yeah, best execution. And, as people and what people have found out is, look, if I take a deal down the road and, I had always used, let's say, Fannie Mae, and Fannie Mae shuts off or the bridge lender shuts off, you need to have, more than one guy who can sort of have relationships. So like when a deal falls apart and you got 30 days to close, that guy can pull in somebody else and make sure the deal gets closed. And that's going to become more and more important because the lending environment in the last, I would say 30 to 60 days has changed a lot more than most people can keep up with.
Yeah,
and that's all we do, right? So we close, I'll close, let's say 3 to 4 deals a month, and most general partners will maybe close 1 or 2 deals a year.
Yeah.
And so for a general partner to think that they know all the lenders and they know what is the best program, it's just too hard.
I appreciate that.
Yeah.
And then what advice do you have for people getting into the business, both passives and first-time syndicators?
First-time syndicators, I would say, there is a lot to learn in this business. So the education piece, I think, is huge. As a first-time syndicator, you need essentially, I would say, 2 or 3 people on your team. Number one, you got to be able to go out and find deals. So you need listing brokers on your team for the market that you're in. You need limited partners who are going to invest in your deals. And you also need co-GPs. You need other general partners who are going to sign with you on these deals, who have experience. And then you need a freaking good lender. So general partners, those would be those people on your team. But limited partners passives, your job is actually pretty easy. You need to get educated. You need to figure out what your investment philosophy is. You need to know how to underwrite deals. And once you do that, your job is to choose general partners. And that's it. Like, that would be my advice, is go out, find good general partners to work with, and figure out what your investment philosophy is as an LP.
And then on the passive investor side?
Yeah, on the passive investor side, sorry, I just hit that at the end. The passive investor side, your job is just find good GPs. Yeah. Like, once you get educated, go out and find good general partners. So whether that is joining groups, whether that is going to conferences, whether that is listening to podcasts, your job as a limited partner is to find good general partners, because your job is not to know who's the best property management company in Dallas. It's not the job to figure out who all the listing brokers are. That's the general partner's job. Sure. Your job as a limited partner is to go out and find good general partners, have them bring deals to you, and then you be able to underwrite the deals and make sure they're good deals that fit your investment philosophy. And the rest of the time, go out and make money so that you have money to invest in deals.
Sure.
But that's it. As a limited partner, your job is easy. Sure. Once you invest in a deal, once you send a wire, write a check, you're pretty hands off. You're not really going to be that into the weeds on these deals. So, for me to scale from 20 or 25 limited partner deals to 100, it doesn't really take up that much more of my time, right? Mm-hmm. So as a limited partner, you can do as many deals as you see fit with based on your balance sheet.
So in terms of your personal portfolio, what percentage is invested in multifamily versus the stock market and other things?
The stock market is actually pretty low. Stock market, I'm probably down to like 5%.
Wow.
And then on multifamily, I've only, all my LP stuff is multifamily. So, probably 40% of my overall balance sheet is in multifamily right now, and the rest is in cash. So as deals come up, then I'll be ready to just deploy either as, an LP in a lot of deals, or just maybe pick 2 or 3 and just put more in them.
And why, that's pretty amazing that, such a low percentage allocated to the stock market. Why is that?
Stock market, I was 100% in the stock market. So from 2005 to 2015, all I had was my 401k, Roth IRA, and, sort of investment accounts, and that's it. And, when I left GE, I was like, all right, how much passive income is coming in from this? And it was like 2 or 3% on that money. And I was just like, in the last 10 years, have I become a better investor in the stock market? And it was no. I had index funds and I had dividend paying stocks, and I had no control over any of those investments. And so what I decided to do was, instead of putting in 20, 30, 40, 50,000 a year in the stock market, I said, all right, I'm going to put 50,000 into multifamily and see what happens, and learn this business and figure out. The challenges to multifamily is you got to make bigger investments, and you got to deal with the liquidity. And because of that, I don't invest. I'm never going to have 90% of my net worth tied up in multifamily.
Sure.
I'm still going to have a larger percentage of cash than I would if I had money in the stock market, right? Because in the stock market, it's more liquid, for better or for worse. People found out for the worse in the beginning of March, and now it's okay, right? It's come back in April, but who knows, right? I just don't Lifestyles Unlimited in Houston. Their founder is Del Walmsley, and he said the stock market is sort of like somebody holding a gun to your head and saying, all right, you got to move out of the way before this bullet hits you in the face. Whereas real estate is sort of like a train coming down the tracks, and you can see the train coming, and all you got to do is get out of the way of the train. And so I think there's just a lot more control in real estate. And I think there's, I don't know if you've read Flash Boys by Michael Lewis, but I have no inside information into the stock market to give me an edge on any deal in the stock market. Versus multifamily is inefficient, and you can build market knowledge and inside information to make better investments.
Yeah, no, that's a point well taken. And then, do you invest in any multifamily funds, or is everything you've invested in just in a specific asset?
All of mine have been property specific assets that I knew ahead of time. I have not done funds. I know there's funds out there. I just haven't seen a reason to do it yet. Okay. And I think if somebody has, let's say maybe you have 50 or 100,000 total to invest, then a fund might make more sense because of the diversification. But I evaluate each deal on its own merits, based on the general partnership, based on the property, based on its cash flows. And some people don't want to do that, right? They want to say, all right, here's the general partner. They've done this for 10 years. They're going to invest in B-class properties across the US. Here's 50,000. Go do it. I don't care which ones you buy, because I won't know the difference between this one and that one.
Sure.
That just is, as you can tell, I'm pretty detail oriented. So I think it's going to be, to me, it's easy, right? When someone sends me a deal, I usually know within 5-10 minutes if this is going to be a deal and I should dig in, or just sort of, all right, it's just, delete and move to the next thing.
Sure. James, well, thank you so much. This has just been incredible. How can our listeners get in touch with you?
A couple ways. I mean, I'm all on all the social networks, sort of LinkedIn, YouTube, sort of start there. I have a website just with my deals. Is txmultifamily.com, shows all the deals that I've closed. And then, you can give me a call, shoot me an email. All my contact information is on those websites, and you can reach out to me if you have any questions about financing or investing. I mean, a lot of I don't get paid to help any limited partners, but a lot of people will send me deals that they're getting and say, hey, can you review this deal? Tell me the good, bad. And I usually try to give them a couple bullet points. And I usually don't tell them what to invest, whether or not to invest in the deal. I just say, look, these are the pros, these are the cons, and then you make your own decision on the deal. But that's always entertaining for me. So if anybody wants to reach out on financing, investing, this is what I do.
Awesome. Well, James, thanks again. Really appreciate you being so gracious with your time.
Yeah. Thanks a lot for having me.
Thank you for listening to Multifamily Rockstars. We hope this episode was helpful for your personal and professional growth. For more episodes and to learn more about investing in multifamily apartments, check out lifechangingcapital.com. underwriting.com.